Global equity markets are soaring and investor appetite for risk appears to have finally recovered. But according to Simon Nixon, this might have more to do with an excess of market liquidity rather than any real return of positive sentiment. Simon, so is this the start of the grand rotation from bonds back into equities or not?
Well, it might be. There's certainly a lot of money flowing into equities right now, and the equity market's been performing very well. But money's also still flowing into bond funds as well. So I think what we're seeing generally is just rising asset prices. All asset prices are rising, and partly due to an enormous amount, you say, of liquidity.
Okay, this is very much characterized the year so far, 2013. But what really triggered the move, do you think?
Well, it's a combination of two things. Firstly, it's the fact that quite a lot of uncertainties that were worrying the market have been taken off the table, or at least have been eased quite a lot. So chiefly the Eurozone crisis, which is obviously now in a much better place. The US didn't go over the fiscal cliff,
We're hoping it still won't go.
Well, we're still hoping that. And the Chinese economy appears to have avoiding the hard landing that people were worried about this time last year. So there's some uncertainties taken off the table. But the second thing is simply an expectation that central banks are really going to come out with all guns blazing to try and get the economy moving again.
But what's interesting here, Simon, is that they have been doing this sort of pouring liquidity, quantitative easing repeatedly for the last couple of years. Do we have any proof that it's actually working?
Well, and this is the issue, is that actually what's interesting is that you've got central banks basically signalling that they're prepared to go even further to try and reflate global economies. The UK Central Bank, the Bank of Japan particularly, and the Fed. But at the same time, what you've got is increasingly a group of central bankers, an increasingly vocal group of central bankers and policymakers starting to say that actually all this money printing isn't actually delivering the desired results, and that maybe it's running out of its effectiveness, that maybe it's actually having adverse consequences, and that people haven't really thought through.
So at the same time, we're having this mega monetary easing policy. On the other side, we're also not getting really very much fiscal discipline. That people aren't bringing their debts down very much, are they?
Yes, and this goes right to the heart of what I say this group of policymakers increasingly are worrying about, which is that they're saying, well, actually, the idea is supposed to be that these rising asset prices will trigger a recovery because partly through confidence and partly through sort of wealth effects. As people feel wealthier, they'll spend more money, and this will somehow get growth going. But actually, what people are now beginning to worry about is they say, well, actually, it's confident that people aren't investing, the businesses aren't investing, households aren't spending. And one of the reasons why they're not doing that is because there's just a great deal of uncertainty out there, because the stock of debt in many advanced economies is still incredibly high. And until people see that debt being addressed and understand how it's going to be repaid, they're not going to feel confident enough to do anything.
But could the counter argument be, well, if this monetary easing produces growth, that's a good thing, and that's a solution to the problem?
Well, as I say, the issue is that people are beginning to say, well, maybe this is never going to produce the growth, because actually what it does, what all this easy money is doing, is it's taking away any incentive for people to actually pay down this stock of debt, to actually address the stock of debt. So zombie companies are kept alive, which is bad for competition, bad for reallocation of resources, means debt levels are still high at the household level and at the banking level. It also means, though, that governments have no incentive to tackle their very big debts and deficits. And you've seen the UK abandon its debt target. You've seen in the US, although they didn't go over the fiscal cliff, there's still now a big debate about what the debt target should be. So what you're seeing is that you see generally people but they're not addressing the debts. People are still therefore very uncertain about whether or not it's safe to invest.
So Simon, as you're suggesting, it might be a case of whether or not this rally is going to continue lasting. Simon, thank you very much indeed.